Michael, thank you very much for joining us today. So much has happened since the last time we spoke, and that was only a month ago. And at that time, you said the S&P had topped out and it broke its long-term momentum, but the Nasdaq did not. And I'm curious, with this recent pullback that we've seen in the last couple of weeks, a lot of damage has been done. Has the Nasdaq broken that weekly
Yeah,
close that you were waiting for?
it was essential because NASDAQ 100 is the leader index. It led on the upside. It doubled the S&P since 2009, in terms of gains. And it will lead the downside. And it broke a couple weeks ago, lagged to the S&P, but now I've got a full breakage of the key indices. And as far as I'm concerned, the market is topped. The only issue now is not whether it goes down, but in what manner. You know, I think it's going to be layers. I don't think there's a crash. Uh, and anyway, but I think it's a very important factor because when you bust a big bubble like that, the money goes somewhere. It always does. You go back through history and look at where did it go when the stock market topped in 29 or mid 70s or the dot-com top or the 2007 top, where did it go? And if you look back, it went into T-bonds and gold related. And this time gold is clearly advancing. It's been advancing the whole time anyway. And it's going to pick up steam now, I think, because the capital flow looking for some other place to be is going to accelerate. And gold is clearly the standout.
And Michael, okay, you said the market's topped out. So the S&P is down 10% from the peak we saw in February. The Nasdaq is down about 13% from the peak we saw in December. And I want to get a sense of how severe this pullback is going to be because we saw a similar shakeout in the first week of August of 2024. It was
Mm-hmm.
all based on the unwinding of that yen carry
Yeah.
trade. And then it recovered relatively quickly within
Yeah.
a couple of weeks. And then we went on to make new highs. And I'm just kind of curious, do you think the correction we're seeing now, is this like August of 2024? Are we going to rally now that let's just say the S&P is around 5,600? Do you think we rally up to 6,000 and come off again? Or what are you thinking?
No, I think we're starting a bear market. And the reason is that the prior breaks that you've seen over the last few years, since the 2022 low, for example, when we had the serious downturn, since that low, there's been an upward process in price and in long-term momentum metrics, like quarterly momentum we look at. It's when we measure each monthly bar in its relationship to a three-quarter moving average. Not overlaying the average. Frankly, I don't care if you're above it or below it. Sometimes that doesn't matter. It's the structure that the momentum chart builds that is distinctly different from what you see on a price chart. So when you see the price chart, you see these breaks, and sure enough, some of them turn back up. But when you look at a momentum chart, you're not just having a break. You just blew floors that go back a couple years on momentum. So we have a structural break that says, no, we've topped. I think you're going to get rally points. I can see one that's maybe about 2% below today's low. Ignore it. A possible bounce point that might be more noticeable is when we return to the 2021-22 price highs. NASDAQ peaked in late 2021 just below 17,000. NASDAQ 100 I'm talking about. S&P peaked in February of 2022 at around 4,800. Okay, so that's considerable percent further down, but it's not a crash. We're talking still, 10% or so below where we are now. And I think you're going to get there. And that may be a bounce point that people start to cheer about. Ignore it. It won't hold. It's just an inflection point. In any trend, up or down, you're going to have counter trend moves. And it takes a while to convince the guys that are on the wrong side now that that move is not real. It's counter trend. You know what I mean? And so I don't think rallies now are salvageable situations. They're to sell into. But I do think there'll be bounce points, period.
Okay, and this is what I want to find out right now. Like if the S&P is at 5,600, do you think we're getting ready for a short-term bounce here? Maybe back up to 6,000
Somewhere
or
below 5,500, I might see that's below today's low by a percent or two. And same with Nasdaq. About 1% or two below today's low would be my trading guess for a bounce point. Something that may last 3 or 4 or 5 days or something. A more significant bounce point is where I said, and it's not just because if you look at a price chart and you see the old highs of 2021 and 2022. So if you're a price chart, it's just, oh, we're back on the old high. Let's buy it. Okay. That'll be part of the motivation. But there's some momentum reasons to expect a bounce point there too. So what I'm saying is right now, if you get a bounce, I don't think it's from here. I think it's a couple percent below here. That should be fairly trivial. A more significant bounce, not in terms necessarily of the upside dimension of the bounce, but in maybe it's holding for a while, is closer to where we were back at the peaks, 2021, 2022, which is another 10% or so below where we are now. So, but I don't see a crash situation. Crash is, if you go back and look through history, 35% or so in a matter of a couple of weeks. 29, 87, COVID. COVID was a good example of a crash event. But usually bear markets don't start with crashes. 29 was an exception. Most like the dot-com top. No, there's no crash. Went all the way down to hell, 82% drop in 2 years in the NASDAQ. But there never was really what you can define as a crash. So I don't think we're going to have that phenomenon.
So this is going to be more like 2000, where on the S&P down 50% in 2 years.
Yes, usually, if you look back through history, usually bear markets last 2-3 years, 29 to 32, 2000 to late 2002, 70, early mid 70s to 74. That was like a 2-3 year thing, and it ended in a crash. By the way, that bear market actually ended with a crash, didn't start with one. And then the 2007 to 2009, that was a 2.5 year downturn. And late in that bear trend, a year off the high, there was actually a crash event where the S&P went down in 1 month, it went down over 30%. But it was already way off its high. It wasn't at the start of the move. And so it's rare to see that at the onset of a bear market. But we've had enough breakage in the last, actually a month or so ago in the S&P and now with the NASDAQ a couple of weeks ago to argue breakage is serious. It's the onset of a bear market.
And when you compare this market cycle to the early 2000s or the tech bubble, okay, we had, oh man, there were some massive haircuts back then. But the poster child then was Cisco, and I think it lost about 80% of its value.
So
now,
NASDAQ 100, 82%. Yeah.
Yeah, now I would argue it's Nvidia, and that's been a beast of a stock, but it's already down 20%, 25% from its highs.
I wouldn't be shocked by $50 on Nvidia before it's over. Wouldn't shock me.
So
what was it, 150, so. But you got to look at other sectors, which we look at all of them, because everybody's looking at the Mag 7, mainly the tech stuff and Nvidia. You better watch the financials. They're going to get injured in this, and
they've been very strong. I'm shocked by how strong these financials
look at
are.
the last few weeks. It's almost a crash event. Banks have just imploded quickly. In fact, the other day when S&P was down 1% or 2%, they were down 5%. Some of the big names, Goldman Sachs, Morgan Stanley, all the big name banks were down. Like the least down was like 3% that day. Most of them were down around 5%. Okay, so there's debt vulnerability out there. I don't just mean government debt, but in commercial real estate, we're watching. There's some ETFs that cover that area. And the banks, I also think Bitcoin, we've been arguing, is moving almost brother sister like with NASDAQ 100. In other words, it's behaving like a bubble. It's moving up weeks and down weeks generally with the NASDAQ 100. And it's starting to implode. I mean, you've dropped from 110,000 to 76,000. It's massive. Well, the stock, like you said, the S&P and Nasdaq down 10, 12%. Look what it just dropped. And there's a lot of vulnerability there, not just in the highly retail market that it is, but there's some companies related that have gotten involved in it in serious ways that could create headline type events off to the side that people aren't thinking about. Now, I don't want to pick on BlackRock, but we've noted it's the biggest asset manager in the world. Okay. It's also a component of XLF, which is the financial ETF. Now, I scrolled through momentum-wise. I looked at the momentum trends of the top 20 holdings in XLF, and they all look just as ugly as XLF itself does, meaning if XLF is breaking down, and it is, the financial sector, technically speaking, in a way that tells me it's going with the high-tech stuff. BlackRock look very vulnerable compared to most of them. And sure enough, we were looking at it a couple of weeks ago. It's dropped another $100 since then. And it has a big, it's an ETF, as I understand it, in Bitcoin. They got involved in that. May have been a big mistake for them. I don't know. I don't know if I don't know the fundamentals. Okay. I'm not going to argue that point. I'm just saying that when these type of events happen, everybody's looking at the highly vulnerable areas, the headline areas, but they better start looking at some other so-called peripheral areas. Because when the damage starts, it pops up in places you didn't expect it. And that creates what? An ambush type effect. Oh gosh, I didn't expect that, And when you create that, you create great uncertainty.
So you're talking about a potential black swan event. And I guess to your point, everybody knows about Michael Saylor. He's probably the biggest cheerleader for Bitcoin. And
Yeah.
his company's MicroStrategy, MSTR, it's already down 50% from its top. I believe he's invested $40 billion in Bitcoin just here in the last few months. Did
Yeah.
raised a bunch of equity and also raised a bunch of debt. And so everybody's looking at that, but you're saying just don't look at MicroStrategy. Yes, that's also quite vulnerable, but look at a name like
It's already
BlackRock.
paid some dues. Yeah, right. And but certain other areas and places I can't even name, I don't even know their fundamentals, that they might be also connected in some way or manner with a collapsing crypto market. But the crypto market looks like it's going to implode along with the stock market. And already look at the percent drop. Okay. And I know where the price guys are getting real panicked. Now, I've got momentum levels that you're trading at right now by getting down to certain price levels. You look at a price chart and you see in the 73,000 area, there was a lot of resistance before it broke through that. And so therefore, a price chartist will look at a Bitcoin chart and say, oh, this is near support now. The old highs. So you got down under 76,000 today. So you're near what the price guys think is the support level. Momentum says, you don't want to be closing a week out around today's low, for example, even before you get to that supposed price support. So price says, gee, this is a place to buy it. Momentum says, no, you can implode right through that stuff. And that's when the panic will really set in, because if you don't hold that zone on price, which everybody thinks should be support now, they're going to throw their hands up in the air. And it's not isolated, but it's definitely something to watch because it is moving with the NASDAQ 100, which indicates to me it's a spec bubble.
And so you said the S&P could drop 50%, which we've seen that many times in history. Yeah. But Bitcoin, what do you think that pullback
I don't
could
know.
be?
It could, nothing would shock me. Not zero, but an implosion, like 20,000 or something, where the whole thing is erased and you have to start all over again.
80%.
I don't know. It's just I have distrust for that sector. I originally years ago I had a positive view of it because a lot of people get involved. I'm a libertarian. Okay, I've written a book on it, 53 years ago, and Bitcoin had the virtue of not being a government money. Okay. It was independent of government fiat capabilities of printing and printing. Bitcoin couldn't expand its supply overnight and double. If the Fed wants to increase the money supply to help save the bubble, it'll do so. and government spending will help. It won't help the break-in bubble, but they'll do that. They can't do that with Bitcoin. They can't just go in there and push the pedal and inflate the supply of Bitcoin. So that was a virtue. But it doesn't compete with gold. I know there's been this intellectual rivalry between, especially the younger folks, say, Bitcoin's the new, it's, the anti-establishment money, and I like it, and it's better than gold. My granddad's wrong.
Quite often it is referred to as digital gold.
Yeah. Anyway, I think that's a sector that could implode on the side along with the stock market and create attention focus outside of NVIDIA. There's other things to watch. And once they engage, and I think technically they are now, in other words, it's not merely NVIDIA breaking down. There's too many other sectors that are agreeing with what I see with the S&P breakage, the Nasdaq 100 breakage. I'm seeing it happen in sectors that have nothing to do, supposedly, with that tech arena. The heavy weighting of S&P and the heavy weights in Nasdaq 100, which, as you know, in the top 10 are these tech stocks. XLF doesn't have that, and yet it looks highly vulnerable.
Okay, so let's talk about gold now, because you mentioned that
Okay.
you're very bullish on gold, as I am. But it's finally making a move here. Let's just, for round numbers, call it $3,000. Where do you see this going? It's already trading at or near all-time highs. It's up 40% in the past year.
Over the last, actually, since you go back to 2015 low, and I suggest this to anybody listening to this, don't even think about momentum. Just go back and look, where was gold in 2015 low? It was $1,050. Okay. Go back, see where the S&P was in 2015, December of 2015, when gold made its low. Go back and see where a lot of markets were then, but look at gold. It's performed quite well. And now when you run a spread chart, which is to divide gold into the S&P and express it as a percent, there's been a multi-year sideways range where gold is oscillated up and down in its relation to the S&P, but well off the low of several years ago, for example, in terms of performance. It's beat the S&P, and yet nobody's cheering about it. You don't see it on Fox Business. Hey, it's beat the stock market. Nobody's pounding that table, which is good. I'm all for that. I want it to be ignored, because then, when it gets attention paid to it, and I think the breaking stock market bubble will bring that flow and also bring the attention to gold. So I think gold is now sitting on the cusp of the acceleration phase.
Well, I don't think
go ahead. Yeah.
I don't think anybody's talking about it, because the move that we've seen in gold just doesn't compare with the move that we've seen in NVIDIA or many other AI stocks.
Well, that's true.
Or in Bitcoin and many cryptocurrencies.
Yeah, that's suddenly imploding, though. While gold is near its high, Bitcoin was 110,000, it's now 76,000. Okay, so what happened over the last couple of months? Gold has advanced for the last 10 years almost in a staircase manner, where you go up 3 steps and back off 1, and maybe you'll lay there for 3 months or 4 months or 5 months. But between 2020, when we doubled gold price from 2015 low to mid 2020, you got up to $2,070. So you doubled the price of gold, and you spent 3 years picking your teeth. Gold was stuck in a 15% range, kept going over 2,000, get hammered back down over 2,000. It was total, everybody thought it's no good. Well, no, that's a launch pad. Sure enough, it's demonstrated. It's a launch pad. But even since early 2024, when we declared it's renewed upside at that point, gold's gone from 2,000 up to near 3. But if you look at the action, it's again this 3 steps up, 1 step back. It's a constant staircase. It's not an explosion. And with silver, it's even worse, because it'll go up like 4 steps and pull back 2. Its upside's more than gold, and its downside's more than gold. And so it shakes teeth every time it dips. Oh, it's all over. That's the top, or we're gonna have to spend 6 months. That process, I think, is about to end, where now you're going to get 10 steps up, 1 step back. And I think the factor that we've been waiting on to help cause that is the breakage in the bubble, the stock market bubble, for a couple of reasons. One, it causes money flow. It always does. It goes somewhere else. Okay. Two, it causes central banks to panic. That's the one asset that every time you break a stock market bubble, and this is the biggest in US history in terms of time duration and multiple gains over since 2009. No bull market has ever matched this. And when you look at an M2 chart, money supply growth, or you look at the Fed funds rate chart, go back 50 years, we've had free money for 10 of the last 15 years. So, I mean, that's like taking drugs. So, that money goes somewhere. The problem is when you break that bubble, it goes somewhere else, but also that's when the Fed comes in and panics. They did it at the 2000 top, the 2007 top. They started cutting rates like crazy. It didn't help the breaking bubble. It went somewhere else, went into monetary metals. And this time when the bubble breaks, the data points will go south in a big way. We keep waiting for unemployment to start shooting up hard, or for manufacturing numbers to start to collapse, et cetera, et cetera. Those data points will do that, but they don't hardly ever do it before the stock market tops. The real negative numbers come once the stock market tops. So I'm suspecting over the next month or two, you're going to start to see very negative data points that will cause the Fed to do what we expect them to do. Not just the Fed, ECB, Bank of Japan, a lot of Western countries, including, for example, India. If you look at the global stock markets and look for bubbles, China is not a bubble. It's only double the price where it was in 2009. It will probably go down with the US stock market, but it's not going to collapse because it's no bubble. There's no exaggeration there. India, however, had like a 6 to 7-fold move in the Sensex index. At the same time, the S&P went up 9-fold. And also the Nikkei had a bubble type move, Nikkei 225. So you can't, and they're broken. Our technicals for those markets say, no, bear market has commenced. And they've come off pretty hard lately in the last month or two, along with the US market. So it's not merely a US phenomenon. We've got a global downturn. And when you bust India, you bust Japan, you bust the US, you're going into a global downturn. And the data points will show. And that will help create the monetary flow to help take gold off the page.
Yeah, I remember the last time we spoke, you were talking about India, and I have to admit that's one market I never look at. But I'm kind of curious that there's a strong correlation between that market and the NASDAQ. Now, you also raised a very interesting point about the Fed, and we know the Fed's always wrong, but it sounds like to me that they're way behind the curve. Would you agree with that assessment?
I think even some of the Fed friends, economists that love the Fed, will admit when we start getting the bad data points, hey, pal, you waited too long. You screwed it up, And there's already, I've said in various interviews over the last year, my bet is when this crisis hits, meaning the bubble breaks and you see the real world consequences, pain in the street type consequences, the Fed will be abolished ultimately. And I think that'll happen in the next couple of years. You now have a political regime that is inclined to want to do that. In fact, they've badmouthed it enough to say that. There's actually a couple bills in Congress right now to abolish it. No, there's not a widespread support, but they're actually been written up, okay? You get this consequence that we're talking about, where, hey, you guys helped do this. You didn't, you're not a good cure for this. You helped the boom bust cycles. We don't need you anymore. What do we need? A monopoly over the quantity of money and the pricing of money. That's not a free market notion. Commodities should be freely priced. Money should be priced by market forces, not by a central government body. Uh, and also, I think income taxes will be abolished. Trump's already mentioned it seriously, during the campaign. And my bet is this, and I'm not advocating anything. I'm looking from above and as an observer, analyzing the pieces here. When the data points get bad, when the stock market hurts people, and the average Joe out there, when the only thing he's got to smile about right now is, hey, my retirement account was up 20% last year. 10%'s gone. Take another 10% off. Suddenly, hey, what happened? He doesn't have anything to smile about. And that's when emotion comes into play. And even the people who voted for him are going to say, geez, at least the stock market went up during Biden's term. Yeah, for reasons that fueled it, the printing of money and spending money and all that. But Trump, when he's faced with that in the street pain, he's got one bone he can throw out there that really will create smiles. And that is, we're going to stick with the tariffs. We're going to tax them. Income tax is gone. And as soon as he even suggests that that's what he wants to do, even if it takes the act of Congress, of course, bad conditions might provoke Congress to actually do it, even Democrats to vote for it, if you have bad in the street consequences of unemployment and et cetera, et cetera. If you're an average Joe out there and you owe taxes on your 2024 income, which was pretty good, and suddenly now things aren't so good, and you hear from the president that he wants to cut taxes, question is, can he actually do that, or at least put a delay in place? Like Biden did. It was a 3-month delay during the COVID crisis. I think he did that. I don't think it took an act of Congress, if I'm not mistaken on that. If Trump even says that, then effectively you've ended taxes, because the public will say, okay, great, that's it. And they'll smile because, hey, I have to pay taxes. So all these other painful events, to some extent, I'm better off because I'm not paying taxes. And he can throw that bone out there. There's no question. And it'll make people smile. And I'm suspecting that all the events we're talking about in the markets and the reality that they create could create these consequences, like end of the Fed, end of income taxes, replaced by tariffs, et cetera, et cetera. All kinds of events like that could happen that are outside the market, but they're really not.
Warren Buffett recently gave an interview, and in the interview, he was asked what his thoughts were on the economy, and
Yeah.
he declined to answer the question.
Oh,
But I don't think you actually need to know or hear him answer the question, because his actions say everything.
yeah.
And in the past year, he's taken his Apple position from
Mhm.
178 billion down to 70 billion. He's sold huge holdings of both Bank of America and Citi.
Yeah.
And
Mhm.
he's sitting on $335 billion in cash. He's the single largest shareholder of or holder of treasury bills now. And so
Mhm.
I think that says everything. And he's quite concerned about the economy. And it sounds
Mhm.
like you are also.
Yeah, no, I think we're headed for a bear market. And because of the dimension of the bubble, I think the bear market could be more serious than 2007 to 2009, which was painful for the guy in the street. Even if he wasn't in the stock market, it was painful. This time it should be worse. We also have government debt crisis. So we not only have, you will have the mortgage situation back then, now we have possibly commercial credit, commercial real estate having a problem. You can watch those guys via RWR and VNQ ETFs. They're ETFs that hold large commercial real estate firms. We technically watch that. We also watch financial sector, the banking sector, because it's the debt problems that once you break the stock market, suddenly those debt problems pop, and it's enormous. Debt, the credit crisis we're facing, I think, is bigger than we've ever seen. And the stock market breakage will help expose that. Uh, and it won't just be a drop in NVIDIA.
And so the unemployment rate is currently sitting around 4%. Where do you see it
Yeah,
going?
I don't know. Uh,
Double,
Sharply,
triple?
I don't know. We don't look at those things. We look at the markets and their momentum trend technicals via our own unorthodox methodology. But what our unorthodox methodology is telling us is this is no good. This is over. The bubble's over.
There's a lot of pain to come.
And I think gold is going to go vertical, and I think silver and the miners will go more vertical than gold.
So let's talk about the price in gold now. In the early 2000s, it went from, I think it was
$260,
$252.
260-ish to 1920. So eightfold move,
So 8 times. Now, you mentioned that the price of gold bottomed in 2015 at just over 1,000. Can you use the same sort of numbers in
No, I
terms
mean,
of a target price?
twice before in the last 50 years, we've had eightfold moves in gold. Where if you look at a logarithmic scale chart, it's the same dimension on a log scale, or instead of an arithmetic point scale. So inhale, exhale, eightfold, eightfold. If we do eightfold again, we're just doing something we've done twice before. But do we have fundamentals and dynamics right now that are far more explosive or implosive, depending on the market, to drive gold, the monetary metal, money, to the upside, more so? So even throwing out the number 8,000, I'm not projecting that technically. I'm merely pointing out the reality that's occurred twice in the prior two big bull markets in gold. From 1975 to 1980, we went from $103 to $850. Okay, and it took you 3.5 years. And then the other one took 10, 11 years, but you went from 260 to 1920. Okay, we're starting from 1,050 low. And yeah, we're in the ninth or going into the 10th year now, but I'm not measuring years because the bull markets have different durations. But the dimensionality is, and with the new factors in play, the implosion of the bubble and the movement of money, therefore, and the increase of monetary excess by central banks, therefore, gold's sitting pretty. It's technically ripe, and I think probably you're going to see the move into new highs, as you issue this interview, frankly, in the next couple of days or week. And I think that move is going to be qualitatively different than what we've seen before. Instead of 3 steps up, 1 step back, or silver 2 up, 2 back, it's going to be something far more accelerated. And people will wonder why. And it's because of the other things we've been talking about.
So if there's investors that are listening right now and maybe they're long cryptocurrencies or they're not they have zero exposure to gold, even though it's trading at or near all-time highs, $3,000 an ounce, there's still lots of room to go on the upside.
Not an optimal place to be a buyer, that's for sure. But on the other hand, you need to make your capital commitments based on trends that are likely to continue. And our view is gold is it's been going up for a while, and it looks like a lot on a price chart, but it's really not in terms of ratio scale moves. And you certainly have dynamics out there that could drive it much higher. And I'm not sure where it's going. I've got some friends who are intellectuals and economists who have arguments that could go in the 20,000s. It would not shock me. But my main technical assessment is when I look at the monetary metals, mama market is gold. It's the mama. Okay, what it does, the others will do. The miners will go up with it. Silver will go up with it. The question is, will they go up more? And if you go back and look at the tail end of that 1979 to 80 bull, silver exploded off the page compared to gold in the latter year or so of that bull. You look at the 2001 to 2011 bull. In late 2010, silver went vertical compared to gold. It accelerated far more. And the miners technically and silver technically, when I assess them in relation to gold on a spread basis, they're in breakout points where they're about to break out of basing type patterns, where they've been, yes, underperforming gold for the last couple of years. Remember the 2020 surge? Silver and miners beat the pants off gold in that surge on a percent basis. But between 2020 and the present, really, they've stayed below those levels, the relative performance levels. Technically, when we assess the spread and the momentum in the spread, we're seeing upturns, breakout levels, where it's arguing, that pullback in their performance is ending. They're now reasserting themselves as outperformers to gold. So yeah, be in gold, but I would stress be more in the miners and be more in silver than gold. You'll get I'm guessing a triple or quadruple better performance there over the next year or so than you will out of gold.
I hope you're right there. So you mentioned bonds earlier.
Yeah,
Are you suggesting investors get long bonds or buy
that's
an
a
ETF like
trading.
the TLT?
Yeah, we called that a month or so ago. We said it's highly likely T-bonds will join gold as an alternative. And as you know, for the last couple of years, T-bonds have been under maximum pressure. They collapsed. We turned major bearish on bonds in October 2020. At that point, T-bond futures were 170. They collapsed down toward 100 area. This is in 2022. And they stayed low. 2023 made a marginally lower low, meaning a higher yield. And again, this year went down close to the 2023 low, meaning yields are still choking. Long-term debt yields are choking those who are vulnerable to high yield debt, even though the Fed cut rates during that sometime and then they raised rates a bit. But when the Fed started dropping rates recently, that didn't help T-bonds. Back last September, I think, they started cutting, not a lot, but a bit. And T-bonds stayed down. In fact, they dropped, meaning the yields went up. So the Fed does not control the long end of that market. What's caused it to upturn recently, we think, is the beginning of the outflow of money from the stock market by major asset managers into what has traditionally been the alternative place to be, supposedly safer. It is not really safer long term. Why? Because the drop that we had in 2020 through recent lows broke the major trend dynamics of the bond market, meaning any rally you get now or drop in yields is a counter trend rally. It's not really the beginning of some new major trend. So it'll be a temporary alternative, and it may last a quarter or so. So it'll be a little joyride for a while. And it'll no doubt be a reflection of money moving out of the stock market, but it is not an alternative this time around to gold. Gold will be monetary metals will be the isolated place to be. Commodities, I think, are also going to turn up. This is also going to hurt Trump because, he said, no, we'll keep them low. The Bloomberg looks like it's ripe to turn up, Bloomberg Commodity Index. And this time it's not going to be led by energy. I think it's going to be led by foods. And we're already getting enough breakout signals on Bloomberg to indicate this time around, when gold goes into this acceleration phase, commodities will actually join it, which they haven't for the last several years. For example, when gold made its low in 2015 at 1,050 price and doubled by 2020, Bloomberg went down that whole time. That 5-year period, it continued down while gold went up. I think Bloomberg is now ready to join gold. So, which is, unfortunately, it was going to happen anyways. It's not because of Trump. And the stock market bubble was going to break anyway. It's not because a new president came in. That was doomed to happen. But, unfortunately, he's going to have that dumped on his plate. And so, again, that might put political pressure on him to cut income taxes to help people pay for things. Anyway, that's another factor out there is a positive, I think. If you're going to be invested, one place to be within the stock market are commodity-related stocks, energy, ag-related stuff. They won't
But
outperform gold, but they'll do well.
if you're expecting a pullback in the economy as severe as
Yeah.
you had alluded to, that's going to be bad for oil and energy. That's also going to come under pressure because nobody's using it.
Historically, that argument, if you look at the XLE, for example, or oil itself, they move quite often contrary to the stock market, and quite often they don't care about a recession or even a depression. Go back and look at the era of stagflation, where we had commodity prices exploding, gold exploding, and the stock market was a wasteland from the mid-70s through 1982. And we were in a global recession, especially in the late 70s. What did commodities do? They exploded. So did oil. So that's a popular thought that, Dr. Copper will reflect the copper's looking good, but the stock market's not. Don't get into that delusional assumption that if you have a recession, commodities go down. They're vastly underpriced as an asset category historically. Stock market is vastly overpriced just compared to its own prices. You look at where the Bloomberg was, for example, in 2008, it was 237. Right now we're trading at 104. Okay. The low was in the upper 50s back in 2000, mid 2020, when gold was already doubled. Bloomberg was down under 60. It had dropped from 230 down to under 60 from 2008 to 2020. While the stock market boomed and the economy was strong, yet Bloomberg went down. The explosion we had last year, no, between 2020 and 2022 was all mostly before that war ever broke out, by the way. In fact, Bloomberg peaked 1 month after that war began. So people like to blame the war for the higher oil prices and the higher grain. It had already occurred well before that war ever took place. And since the war began, commodities have pulled back from what? 140 down under 100 and gone dead for 2 years, either side of 100. But even at 100, they're less than half where they were in 2008. So they're still dirt cheap as an asset category, and they will attract money. So recession or not.
So, Michael, let's just summarize a lot of the points you made. So you think both the S&P and the Nasdaq have topped out on your momentum, long-term momentum basis. And this is it. This is the beginning of a significant downturn in the market. It's not going to happen. You're not looking for a crash where we see down 10 or 20% in a short period of time. This is going to be a long, slow grind to the bottom. Might take place over 2 or 3 years, but a pullback of at least 50% in the S&P. During this time, you also think any sort of risk asset like Bitcoin, for example, that's also going to be annihilated down 60, 70, 80% if it's anything like what we saw during the tech bubble.
Would not surprise. Yeah.
And then, so in order to protect ourselves, we want to get long gold, get long silver, get long bonds. You said some other commodities, also oil?
I think generally the commodity category, I'll give you a number. We get very specific with our subscribers, and we adjust our numbers based on certain time frames changing, three-quarter average changing with the 3-year average, and adjusting for the structural breakouts of momentum. But right now, Bloomberg Commodity Index traded up like over 107 in the recent surge. They pulled back. It's now, I think, pushing up toward 105 again, 104, 105. You close out a month above 105, let's say. I think you'll start to notice the upturn more clearly. 105 doesn't, when you look at a price chart, doesn't alert anybody that there's an upturn. But from momentum perspective, it says, yeah, there's an upturn. Get ready for price to start to move. You ever get back over 120? Think about this. The last rally high hit 140. This is back in 2022. Now I'm saying you get back to 120, which means just halfway back to that high, and you're going to blow some stuff that'll cause a real acceleration in commodity prices. And I'm not going to argue what will be the factors. Now, I know Trump has thrown out this drill thing, but that's not something you push a button and it happens. Okay, we know that. And there's other factors in the world, not just U.S. production. So we don't deal with that. But focusing on that, I think, is a mistake. Focus instead on the broader view that, one, commodities don't necessarily go down in recessions. That's certainly not the case. And two, they're cheap. They're cheap relative to the stock market. They're cheap relative to their own price levels. So when you move out of something that's breaking and very high priced and high risk, you want to buy something that's what? Low risk, better reward potential. And commodities are bombed out. They weren't going to go to zero back in 2020. They traded under 60. They'd been 237. That's like getting to zero. Okay, and even at 100 area, that's not expensive. So commodities are still globally cheap compared to other assets. And I think that is a driving force.
Well, this has been a great discussion, Michael, and I want to thank you very much for spending time with us today. If somebody would like to learn more about you and your services, where can they go?
olivermsa.com, Momentum Structural Analysis. Take your time, tool around. We discuss our methodology, which is not orthodox. We've been around since 1992. We began originally in the first decade or so with only institutional clients, major funds, banks, and so forth. But we expanded to retail subscribers in 2015. And we cover all four asset categories, which is important because, you don't just look at gold and think you know what's going on. You've got to look at what's going on elsewhere because things impact one another. And that, certainly today.
And to your point, you're saying you're not a gold bug, you're not a crypto bro, you're looking at
We've been bearish
individual
on gold before.
assets.
Back in 2011, 12, we got major bearish. 3 months off the high in gold. We stayed bearish, even though gold went sideways for a year after that peak high in 2011. It dropped a couple $100, but went sideways. Everybody thought, oh, it's going to go up again. We said no. We stayed bearish until early 2016. We turned long-term bullish and haven't changed since. So yeah, we're flexible. I'm a gold bug, fundamentally speaking, you can say, because I distrust government money. It is fiat, it's paper, and gold is money. But gold has downturns of significance. Right now, you're not going to face one. You're facing a major upside acceleration.
Well, this is great, Michael. We're going to have to do it in a couple of months, and it's going to be
James.
interesting to see how things shake out here. But
Yep.
once again, thank you.
Thank you very much.